Hi, good afternoon, everyone. My name is Arjun Mehta. I represent GH2 India, and it is my privilege to welcome you all to this webinar. It's the 8th of August, 2025, and we are excited to have a webinar today. Six of the webinar in our series, Green Hydrogen India webinar series, number six. And today's topic is an exciting one for me. It's charting India's sustainable aviation fuel future or SAF future. And we'll be talking about regulations, demand, economics for a sustainable takeoff. So I thank each and every one of our participants, and they are rising by the second. We've had over 300 registrations, and we are very excited to host you all for this brilliant topic. We'll give everyone another 30 seconds to join, so we know that most people have it started off. Great. So let's commence, everyone. So it's the 8th of August again. Let me remind you, this is Chatham House rules. So I request all the speakers. I will introduce all the speakers briefly, and I will let them introduce themselves, subsequently as well during their sessions. This webinar is scheduled for 1.5 hours. It's 4 p.m. in India at the moment, and I welcome all our colleagues from the entire world, especially time zones which are beyond India, considering it's a Friday evening. So thank you very much, one and all, for joining our GH2 India's sixth webinar on sustainable aviation fuel. So let me commence by saying that this is broken into essentially three components. The first is a brilliant presentation. I've gone through it myself. It's by Arcus. Sarah has kindly agreed to join us from Arcus to deliver this presentation. I'll introduce her to you now. She is the associate editor handling biofuels and net zero at Arcus Media. Arcus, of course, as I'm sure many of you will know, is a global leader in pricing and analytics for biofuels and SAF markets, and they help industry track policy, feedstocks, and trending trends. Sarah reports on SAF and the feedstock that goes into producing SAF across the Asia Pacific region, and she covers everything between used cooking oil supply chains to pricing shifts, and of course the policy and market trends as well. So she will deliver a presentation for the first 20 minutes of this webinar, followed by an exciting panel with industry veterans who I'm sure I'm going to be learning a lot from, who are all from the aviation fuel segment. I will introduce them once their session is done. The third component, ladies and gentlemen, would be towards the end of the program in terms of asking questions. We will try keeping it to at least 10 to 15 minutes worth of questions because I'm sure, like myself, a lot of you will have queries on this exciting topic within the decarbonization space. So feel free to drop your Q&A into the chat box, and we will take as many as we can at the end of the session together. So, on the behalf of GH2 India, I welcome you all again on this Friday, 8th of August, and to learn as much as I do from the eminent speakers on the presentation and the panel. Sarah, over to you.
Um, Good afternoon or evening, everyone. As Arjun has mentioned, I'm Sarah from Argus Asia Biofuels team, and today we're going to look at both demand and supply factors as well as market events influencing SAF markets in the present as well as near future. We will also look at feedstock dynamics in the biofuel space and of course introduce our biofuel services at Argus too. So just some compliance notices that I have to show before we get into the presentation proper. Yeah, so as Arjun has mentioned, Argus is a price reporting and market intelligence agency. We cover a wide range of commodities from biofuels to oil products, carbon markets, and more. So on the screen, you can see our biofuel services. On the left hand, we have our daily spot market reports, one global report and another focused on the US. So over here, you'll find the latest prices, market commentary, and analysis. We also have our short-term outlooks. Here you can find forecasts on markets around 6 to 12 months out. And on the right-hand side, we also have more medium-term forecasts by our analytics team. This will have forecasts on the market up to the 2030s. And finally, if you have a specific need which you would like expertise on, our consultants at Argus also do bespoke projects tailored to that as well. Yeah. So as mentioned, this is our agenda for today. First, we'll have a market update, then we'll look more at biofuels, feedstocks, and then finally our pricing solutions. So first, to set the stage, how SAF markets will do depends largely on both demand and supply, which is typical of many commodity markets. But biofuels, as we are probably aware, is unique as demand is heavily influenced by mandates. And not just that, in times of great economic uncertainty at present, if there's penalties for not adhering. Policies in various countries definitely vary, as we will see later, and offtake agreements are important as well. On the supply side, it's not only influenced by demand, but also feedstock availability and eligibility, which can vary via regions, and the progress of SAF plants coming online too. So to start off, here are some announced SAF mandates in APEC so far. As you can see from the table on the right, although volumes in comparison to total jet fuel consumption are definitely still small. India, as you are probably aware, has announced the 1% mandate to start in 2027 to rise accordingly to 2030. But as we know, more detailed roadmaps as to how these targets will be met are still pending. And as such, Europe still maintains the key export destination for Asia's SAF at present. I would say what the market is currently focusing on at the moment is China's potential announcement of a huger SAF mandate than its current 50 KT target over 2022 to 2025. We are hearing from the market that they might announce a huger mandate either end of this year or next year, which will definitely be a game changer. A lot of Chinese UCO will potentially be kept domestically, but nothing official has been announced as of now. So shifting our focus to supply, the picture at present is definitely that of oversupply. The nameplate or maximum capacity of operational plants in Asia, marked in dark blue, is already 2.8 million tons. And this is in comparison to Europe's total SAF demand, which this year, with their 2% mandate, which is just under 2 million tons at present. And this is not counting the plants in light blue, which will likely come online by this year and add an additional 1.7 million tons of capacity. But something important to note is that these SAF production plants might not run at full rates, potentially limited by the expected feedstock shortage for HEFA SAF production moving forward. So this might still help to temper the oversupply picture. And for the plants in pink, so there's Fuji Oil's plant and BP's plant, they actually decided not to go ahead due to unexpectedly high construction costs in Japan, for example. So turning our attention to the European market, all eyes are definitely on the EU with its 2% SAF mandate this year. So as you can see on the graph, SAF is represented by the red line, while HVO or hydrotreated vegetable oil is represented in dark blue. So while SAF prices were generally at record lows in May 2025, as you can see, they have been climbing thus far, and there's a recent spike in August as well. There have been a few reasons for this increase. As we head towards the end of the year, fuel suppliers have to start fulfilling their mandate, and a lot of them choose to meet it in summer because that's when jet fuel demand rises as well. And therefore, buyers would be slightly more willing to pay a premium for their SAF. And also, interestingly, if you can look at the HVO pricing, HVO was trading at a discount to SAF for most of 2024, but in 2025, HVO has started trading at a slight premium. It's important to watch these two markets as we know that producers have the flexibility to switch between these two products. And some reasons we are seeing for strong HVO markets in 2025 would be certain supply sentiments, sentiments of tight supply earlier in the year, with some factors like producers having their ISCC certifications revoked, etc. And not only that, but also generally higher mandates across Europe. There's also been the anti-dumping duties on Chinese HVO from the EU that has tightened HVO supplies coming into the EU and therefore pushing up HVO prices. But as HVO prices rise, we have been hearing this week that producers are producing more HVO instead of SAF. And therefore, the SAF supply tightness has caused a spike in SAF prices as well. So as we can see, the balance between these two products will be quite important to watch moving forward. As we have heard since last month, I would say, many countries in the EU have started publishing their RED III drafts or the Renewable Energy Directive drafts that will be implemented in 2026. Our consulting team expects that this likely won't have so much impact on SAF, as EU's aviation sector has already the mandated targets under refuel aviation of 2% in 2025 to rise to 6% in 2030 and 20% in 2035. And since they already have this organized SAF targets, it likely won't affect SAF. But what's important to note is on the HVO side. So we expect HVO demand in Germany to potentially rise by 1.5 million tons next year. And one factor for that is Netherlands and Germany proposing to abolish double counting of Annex 9 feedstocks. And this will mean that obligated parties will need a broader fuel mix to meet higher targets. Because, for example, 1 ton of biofuels will not count as 2 tons to fulfill the mandate. And therefore, we expect HVO demand to rise significantly next year. So these are some estimates from our analytics team. Generally, we are still expecting an oversupply of SAF up till the 2030s. So the supply of SAF is represented by the bars, while demand is shown by the pink line. So as you can see, like by 2030, global SAF supply could be more than 30 million tons, while demand is less than 1/3 of that. But this is important to note that this is not including the additional Asia SAF mandates that we mentioned previously. And for the portions in gray, these are very provisional SAF projects. So this means that the project has been announced, feasibility studies are underway, financing may be in progress, but FID is not taken and groundwork and construction has not begun. So if these is still quite in the balance whether these plants will come online, and this might help to temper the supply demand picture as well. And also, when we include both renewable diesel or HVO supply and demand, the picture is much more tempered. So as you can see in 2029, renewable diesel and SAF demand is expected to be on par with supply that has already been announced. And therefore, if India is looking at developing SAF, we think that there's definitely still more opportunities in this area for sure. Okay, so moving on to a deeper dive into the SAF production feedstock landscape. As you are probably aware, SAF feedstock eligibility definitely varies by region. The US focuses a lot more on carbon intensity, or a measure of the amount of GHG emissions, particularly CO2, produced during the entire life cycle of a biofuel from production to consumption. So while soybean oil is a huge feedstock in the US, the Refuel EU aviation regulations state that soy and palm-derived materials are not allowed for SAF production. And meanwhile, here in Singapore, we are still open to all CORSIA-eligible feedstocks, which includes products like palm fatty acid distillate, which also isn't permitted under Refuel EU. And for Japan, they recently proposed that a minimum greenhouse gas saving of 50% would be required for all SAF used to meet obligations in Japan, and this will likely favor feedstocks such as UCO, which has higher GHG saving capabilities. So as you can see, with these varying acceptance of feedstocks across the globe, this could create a two-tier or multi-tier market moving forward. So turning our attention more to Southeast Asia, which is slightly important for India since you guys are quite close by. This has been a huge factor impacting feedstocks markets since January. So this slide basically shows a timeline of events since Indonesia implemented an export ban on both crude UCO and POMI in January this year. Fast forward to the present, as you can see in yellow, many UCO and POMI oil suppliers in the country are not really expecting the export ban to be lifted, and numerous of them have pivoted to supplying refined POMI oil and refined UCO instead, which are not affected by the ban. So just very quickly, the rationale behind the export halt was to keep more crude palm oil supplies within the country for Indonesia to meet its B40 biodiesel blending mandate. So they saw that a lot of this CPO or palm olein were being blended into UCO and POMI and being exported due to high prices for these waste materials. And they wanted to clamp down on that, hence the export halt. Yeah. So this has considerably tightened feedstocks in Southeast Asia since. In the pink boxes are basically a lot of the meetings that have transpired since January, all of which have been inconclusive. And we would say this issue has slightly on the back burner as well, as Indonesia has had to negotiate with the US on the tariffs. Something important to note in May, though, is the increasing of export levies on UCO from 6 to 9% of the CPO reference price, and on POMI from 7.5 to 10% of the CPO reference price as well. So even in the event that the export ban is lifted, these higher export levies could be a deterrent to suppliers choosing to export these waste products. So as already mentioned, if the ban is lifted, which is pretty unlikely, we expect UCO and POMI oil prices to soften in the short term with additional supply, but this will likely be quickly absorbed by regional SAF plants. So Ecoceras Johor plant is expected to come online in this year's fourth quarter, as is Bangchak's SAF plant in Thailand. And we have already been hearing them buying up a lot of UCO, both in the Strait of Malacca and in China. And let's say if the ban remains, which is more likely, we would say, the price, the market has already priced in a loss of feedstock previously. And if of interest, Indonesia's UCO demand will probably only significantly pick up when Pertamina starts their SAF and HVO production on a huge scale, likely in 2028 to 2029. And therefore, suppliers in the country have been pivoting to other products, as mentioned, although some UCO suppliers are still supplying domestically to biodiesel plants and the animal feed industry. Yeah. So we know that ethanol is really huge for India. Yeah, and we have a reporter on the team who specializes on Asia ethanol as well. Yeah, but this is just some background on neighboring feedstocks in Southeast Asia, namely UCO and POMI. So on the left-hand side, we've seen that Strait of Malacca, UCO and POMI prices have risen to record highs in July and August, and they're still remaining there due to Indonesia's export ban and increased buying from SAF plants in the region. We expect that prices will likely remain elevated moving forward. So UCO and POMI oil generally track crude palm oil futures, as you can see from the graph on the right. Yeah, so that would be an important reference price to watch as well. Turning our attention to China, which till now is still the largest supplier of UCO in APEC. As you can see from the graph on the left, FOB China UCO prices are currently at more than 2-year highs. And we see this due to two factors. Firstly, tighter domestic supplies due to a slight slowdown of China's economy, people are not eating out at restaurants as much, and therefore UCO collections have slowed. But at the same time, there has been increased demand for Chinese UCO from overseas biofuels producers in Europe, for example, and therefore the double whammy from both the supply and demand side has pushed up prices significantly. On the right, we can see China's premium UCO prices, which is what the SAF producers typically look at. They have also been on an uptrend thus far, with the domestic price in dark blue. This has also increased with a lot more demand from Chinese SAF plants coming on stream. We are already seeing nameplate capacity from China around 1.7 million tons for plants that are already running. But just turning our attention to the US, this is important because they used to be the biggest buyer of Chinese UCO back in 2024. But things and policy changes have definitely changed a lot since then. Yeah, so this is just some background on the situation there. So from the graph on screen, this shows China's UCO exports from 2024 up till now. The US imports are shown in the dark blue bars. So the US actually took close to 50% or 1.3 million tons of Chinese UCO in 2024. But in the first 6 months of this year, their imports have slowed to just above 200 KT. This is due to various factors. Firstly, since January this year, biofuels in the US manufactured from foreign feedstocks like Chinese UCO was not able to claim the 45Z credit anymore. Some SAF producers in the US have still been able to find a workaround around it, so they can claim this credit still under CORSIA or the GREED model. But from 2026, as you can see on screen, the EPA has proposed halving the amount of credits under the Renewable Fuel Standard, or RINS, for both imported biofuels and biofuels made in the US but from foreign feeds, like Chinese UCO, Australian tallow, for example. And next year, the CORSIA workaround for SAF producers that I mentioned will not apply anymore. In latest policies, we've also heard that SAF in the US can no longer claim larger subsidies than road fuels of equal carbon intensity, but that's just a policy for now and it still can change moving forward. Yeah, but something to note is that certain biofuels producers could still be able to claim duty drawbacks. So this is known as exemptions on certain imported feedstock tariffs if they ultimately export the biofuels that they produce. Yeah. So among all the factors of feedstock tightness, this is a slightly bearish one, but granted, it has also gone on for a while already. And definitely, as you can see from projections from our analytics team, eligible heifer feedstocks from existing sources are limited. So the demand is shown by the bars on the chart, while feedstock availability is shown by the blue area. And you can see we are going to get very tight, especially as we step into the 2030s. And that's precisely why certain companies have been looking to alternative feedstocks, as we'll see in the next slide. So for example, as you can see, Australia's Rio Tinto have started developing Pongamia seed farms in the country as part of a new biofuels pilot study. We hear that Jet Zero is looking into that as well. And EPA has also entered into an agreement with Australian agribusiness New Seed, and as have other companies have been doing, as you can see on screen. But definitely for these alternative feedstocks, research is still ongoing, as you guys are aware, and they require investment for sure. For example, in the case of Pongamia, it has high oil content, it's resilient, but scaling up production could be difficult, and we are still looking at the yields from these alternative feedstocks as well. So finally, allow me to share with you some of the pricing solutions that Argus has, both on the feedstock side and finished biofuels. As we are already aware, UCO and crude oil markets are definitely very different. Crude oil is affected by geopolitical factors like OPEC cuts, unwinding, etc. While and generally for crude, it's from fossil fuels in the ground. For UCO, on the other hand, the collection process is much more arduous, it's slower, we need to collect it from restaurants, food factories, etc. And as you can see from this graph, a dated Brent is shown in dark blue, while FOB China UCO, which is the key reference price for UCO in Asia at the moment, has moved in very different directions since 2018, therefore necessitating biofuel specific pricing. Similar to UCO and crude oil, we've definitely seen jet fuel and SAF moving in very different directions as well. Jet is definitely more liquid, while SAF is a more nascent market. So as such, this slide shows the suite of pricing that Argus has for both biofuels feedstocks and SAF. So on the feedstock side, we have our FOB China UCO prices, as well as our domestic premium UCO prices. On the FOB, we also have values for premium UCO as well. In the Strait of Malacca, as mentioned previously, we have assessments for UCO and palmy oil, as well as Australian tallow. So for SAF, I would say the most liquid price at the moment would be our FOB ARA SAF price. But definitely liquidity is growing on the China side as producers start exporting more cargoes. We also have a FOB Singapore SAF price, but this is currently a netback from Europe. It could move to being an assessed price as more capacity comes online in Southeast Asia. And just very quickly on the right side, we have our futures contracts for both for UCO, biodiesel, and SAF with ICE as well as CME. So if you're looking for sort of a hedging tool for SAF, our SAF futures contract with ICE is the first and only actively traded contract globally at the moment. It could be something to consider as well. And on this graph, so this shows the activity for SAF on our Argus Open Markets platform, which runs from 4 to 4:30 UK time. We also have a similar platform in Asia. So since we launched SAF on the platform in April 2024, 30 KT of trades has been initiated, and we've seen more than 400 KT worth of bids and offers. So if you're looking to see the market activity for that, this would definitely be a good platform as well. For our futures contract, we have seen around 255 lots being traded since it was launched in December last year. Okay, so this is pretty much all I have. This is a summary of our upcoming conferences and events. Nearby, we have a complimentary forum in Singapore on 9 September. So if anyone's going to be here for APEC, feel free to drop by as well. And definitely we have our America and Europe conferences. And finally, we have our WhatsApp channel. So over here, you'll get the latest bite-sized news and updates on biofuels markets. And the other QR code will just lead you to our full suite of biofuel services that I mentioned at the beginning. So thank you all for listening. And yeah, we will take any questions after the panel.
Thank you immensely, Sarah. That global outlook on the SAF market was fabulous. I think some of the key data points that I absorbed and some of the commentary that you mentioned are quite critical. The first is the size of the global market for aviation overall. From what I understand, to our listeners, aviation as a sector contributes to over 2.5% of global GHG emissions, which is a large footprint. And in India, we are at about 0.7% for India's emissions footprint, which is a good thing that India is underplaying the global emissions footprint contribution from the aviation market vis-a-vis the rest of the world. But it's also a big opportunity for countries like India to look at the rapid growth in the domestic aviation market going forward, to look at greening it as much as possible using greener aviation fuels. So I think that sets a very good context. And a couple of other data points, Sarah, that you mentioned. One is all eyes are indeed on the EU market with the 2% blend for SAF in the near term. but it's also exciting to know that the Indian regulations do target a 5% blend for SAF going forward as well from
Yeah,
2030 onwards.
2030.
So it's a market which is ripe to open up. And a lot of our members as well within GH2 India who are green hydrogen and green ammonia producers are indeed considering getting into the SAF space, which is a brilliant market to enter at this moment in time for India. One other important set of takeaways, Sarah, from your presentation that I had, just for the benefit of our listeners, is that we spoke about blending regulations, both in Europe, in Asia, or let's say briefly in India as well. We spoke about duties and duty drawbacks. We did touch upon the export levies as well, which I hope to bring up in a panel discussion after at this moment. We spoke about the challenges on availability of the feedstock, which remains a large bottleneck in the production of SAF through many of these pathways. And an important one is looking at which companies in the world are taking up SAF production at scale. For example, the global majors such as Rio Tinto, BP, ENI, UPM, and a few of the names that you mentioned, Sarah. And we hope to see a lot more from India and the Asian region as well, contributing to SAF production globally. So exciting times. And that's a brilliant segue into the panel discussion as well. So thank you very much again, Sarah. Sarah Giam from Argus, everyone. So I congratulate her on the presentation, and then we'll move into our panel discussion now. Great. So in our panel, and I will try keeping it to 45 minutes of the panel discussion. And at the end of the panel discussion, we will open it up to Q&A, both for Sarah as well as the panelists. We have 5 exciting panelists today with us. Let me welcome Alvin Chu, who's Sarah's colleague from Argus. He is a vice president covering refined products and biofuels. We have Vineet Bakshi, who's director at LanzaTech or LanzaJet, who handles business development for the company. LanzaTech, of course, is a global pioneer in converting industrial emissions and biomass into low carbon fuels through the ATJ platform. We will talk about the ATJ production pathway during the discussions as well. Vineet leads the SAF market development for LanzaTech and LanzaJet in India, and he works with refineries, of course, to scale up the ATJ pathways using waste gases and domestic feedstocks. So, Vineet, expect a lot of feedstock challenges and bottleneck-related questions to come your way. Sanjeev Kumar is the business head for aviation at BPCL. Sanjeev, again, welcome. Excited to hear you speak. BPCL, of course, as everyone knows, is one of India's largest refineries, and it's investing heavily into the SAF production segment as well. Sanjeev comes with over 3 decades of experience. He's a veteran in the aviation segment. He leads the aviation fuel production team at BPCL and the SAF strategy as well at BPCL. I welcome Sanghamitra Bhattacharya, who is with Praj Industries. Again, it's a name which is very, very well known in the aviation segment. So, Sanghamitra, welcome to you. Praj is a homegrown biotech engineering firm based in Pune, and that's, of course, at the forefront of ethanol as well as SAF, both the pathways, that Sarah was mentioning in her PPT. Sanghamitra is also very, very experienced. She brings 18 years in the space, handles engineering and commercialization at Praj. And we will talk to her about the production routes and the regulations as well around all of this. Lastly, but not least, Pankaj Agrawal, who heads the fuel farm business at Adani Airports. So it's important for us to know, the views, downstream in the value chain as well. So we welcome his views. Adani, of course, operates aviation fuel infrastructure other than airports. And Pankaj leads this transformation within the company. Pankaj's team focuses on blending infra, storage, and distribution of SAF and conventional aviation fuel as well. So he has 25 years in the downstream energy space, and I'm excited to hear his views more as a consumer and a facilitator within the infra segment of here. So the way we've constructed this panel, ladies and gentlemen, is to have views from different parts of the value chain. As you might have seen, we've talked about the demand globally and in India. We've talked about the regulations globally in the Asian region, certainly, evolving ones in India. We've looked at the demand and supply dynamics, willingness to pay, production costs today, different production pathways. We'll touch upon that as well. But most importantly, we'll leave the listeners with some food for thought in terms of what the regulatory measures are like today, globally as well as in India, and what the regulatory interventions might look like or should look like going forward. So we will try covering demand, supply, production pathways, and regulations in this webinar. And do bear with me because my job as a moderator is difficult asking so many questions in such a short span of time. But let's try doing our best. Again, on behalf of GS2 India, I welcome all our speakers. So let's get into it. So let's start with the first segment on demand, and I welcome any of the five speakers in the panel, or perhaps I can call out who I think would be best suited as well. So the first segment for the next 3 to 4 questions would be on demand, the most important point here. So from a demand standpoint, we've just talked about India consuming over 9 million tons worth of conventional aviation fuel today. And we are looking at a 1 to 5% blend over the next few years, going up to 2030 and beyond. Now, this is a very exciting time for the sector globally, really, where we've looked at hard to abate sectors within transportation, and aviation is right up there, contributing to 0.7% and 2.5% in India and globally for GHG emissions. To decarbonize a lot of this, we will need a lot of demand, a lot of unlocking levers to open demand up. So, with 9 million tons worth of aviation fuel consumed in India, where do our panelists see demand for SAF in India go up? Is it regulations linked, or is it willingness to pay and the pricing linked, or is it a voluntary take up of aviation fuel? So let me start by inviting Alvin to give your regional view. Alvin, if you can talk to us about what Argus and you think from the regional market, since you're based in Singapore, and then perhaps we'll synthesize this to the Indian context. Alvin, over to you.
Sure. So if I get a question right, basically you are asking what do I think about whether would there be huge voluntary takeout of SAF by the airlines, or is it or demand will largely be regulation driven? Is that right? So based on my interaction with most of the airlines in the region, if we look at the SAF price now, which according to Sarah's explanation, SAF is oversupplied, right? So prices are at record low levels. It is still close to 1.5 times that of jet. So from a competitive perspective, most airlines that I've spoken to that I know of are not willingly that willing to use SAF in their operations. So if you look at demand for SAF now and why we consider Europe as the epicenter is because it has a very strict mandate. So my perspective is unless there's a very strict mandate requiring the usage of SAF, most airlines would tend to prefer to use jet because they will find it very difficult to also pass on the cost over to their consumers. And that's why when we look at mandates around, for example, Europe has a strict 2% mandate, Singapore has a 1% mandate. Of course, that's a different system. Japan has a 10% mandate. So for example, like countries like Thailand, they might introduce a 1% mandate next year, but that is purely on a voluntary basis. So our interaction with certain markets, for example, like in Japan, where a mandate has been announced, but without gradual implementation roadmap, some of the SAF imported are sitting at the tanks. So currently, if you look at the SAF market, it's still very much a regulation-driven market. But there are still some airlines that have publicly announced SAF targets. For example, famously, Cathay announced a 10% target. They have been very open about it, that they will likely will have 10% mix within that. For these airlines, they will be more willing to buy SAF. But if they don't announce a public SAF target, most of the demand from my interaction with the airlines is still driven from regulations.
That's an interesting point, Alvin, where you look at the comparison between what's driven by regulations, more of a push, and what's driven by, let's say, the inherent need to decarbonize and more of a voluntary target, which is more of a pull. If I might ask you a follow-up question on what you said, when it comes to, let's say, Cathay Pacific's 10% blend, target for SAF, What do you think, not necessarily one company's target, but what do you think drives a voluntary take up of greener fuel within the aviation space?
I think it has a lot to do with their ESG strategy. For certain airlines, they have a very strong ESG strategy. And of course, with a strong ESG strategy comes with strong ESG reporting. So with these airlines, they will definitely be willing to use more SAF. I've also been in contact with certain airlines, which of course I can't name the names, which have identified a target, but in the end, due to the cost, and that has then withdraw the target or actually lower down the target as well. So to answer your question directly, it is definitely coming from a very strong ESG strategy, which sometimes I feel is led by the CEO of the company, that has a very strong ESG vision. For such airlines, they'll be more than willing to use SAF. But again, how they pass on to the consumers is beyond my knowledge. But yeah.
Now, those commercial models are indeed going to evolve, Alvin. Thanks for your regional view on this. Pankaj, if I can bring you in, from Adani Airport's perspective, of course, you're one of the major airport infra developers in the country, but that also puts you in a very unique position that you're between the fuel producers and the fuel consumers within the aviation space. Where do you see demand for SAF in India, driven again, by either regulations or voluntary take-up? What are your views?
Yeah, thanks, Arjun. Thanks for inviting. So first of all, let me tell you that I'll give you the view of my group and my business unit. So in Adani Group, leave behind the airport business, in each business vertical, sustainability is at the top of the agenda. It is at the top of the agenda. And my business unit, Adani Airports, is no exception, right? And there are two reasons for that. First is that, of course, it is corporate guideline from the top, from the promoters. And secondly, we have a very profound pressure from the ecosystem to have SAF and to have sustainability and to reduce the carbon emission at our airport. All our stakeholders, all our investors, whatever performance metrics they have chucked out for us, sustainability at the top of it. Let me tell you, we are so active. Our ESG group is so active that our Mumbai airport is carbon neutral for now 3 years, and it has already acquired ACA Level 4 accreditation and targeting for Level 5 in next couple of years. And all other remaining airports, we have 6 more airports. They want to. We have a wish list to achieve ACA certification Level 4 in another 2 years' time. My we have an airline marketing group within the company, and we keep interacting with airlines. And what Alvin says is partially true, but what I feel, I don't know what is going to happen in future. But as of now, there are multiple queries from the airlines, especially international carrier, that what is our plan regarding to SAF, right? So like we're constructing a new airport at Navi Mumbai. This is going to be a second airport at Mumbai. It will be a mega airport. We are expecting a tax of around 80 million in next 10, 12 years. And whenever we talk to international carriers, SAF is in the agenda. So I don't know whether commercially how they're going to react based on the cost of pricing when we started. But currently, I see there is a lot of query and a lot of enthusiasm in it. Secondly, from the regulation part of it, Arjun, if let's assume we don't know what is going to happen, but let's assume that government of India is going to have a clear mandate that our airports, it is mandated that SAF will have 1% blending of synthetic kerosene. Then I don't think that that would be a big challenge. Although I'm not from the supply side, but I understand SAF is nothing but the blend of conventional fossil fuel and the synthetic kerosene. And even if synthetic kerosene is 5 times costlier, then 1% blending means hardly 5%, 2 or 3% or 5%, difference in cost. So if there is a mandate from the government, like we don't know, I think most of you must be knowing that currently there is a 10% methanol blending in petrol which we use in India, right? So if some sort of that mandate comes, so I don't really see that up to 1% and 2% blending, there would be a resistance from the airline. But yeah, if you talk about a higher blending ratio and the prices are more, then of course there would be resistance. But yeah, there is a deviation in it. I really see a resistance in Indian domestic carrier because they are too much price sensitive to fuel. So I'm not really upbeat about that. But for international carrier, I feel that there is a certain amount of enthusiasm. And as an airport operator, I am willing to go for SAF for any come what may because I need to make my airport carbon neutral in the near future.
Yeah, that's fabulous to know, Pankaj. Again, we welcome your group's sustainability-driven targets as well. That's very nice to know that there's such a strong focus on ESG within the Adani Group and the Adani Airports division. If I can, ask a follow-up question on this, to perhaps even to LanzaJet, right? So let's bring Vineet in for this particular question here. LanzaJet, similar to the Adani airports in a way, is more of a facilitator within this entire ecosystem, isn't it, Vineet? You're a technology-focused company looking at producing SAF through various pathways. So why don't you tell us and the listeners a little bit in terms of where LanzaJet is here today, and then take it up to in terms of where you think demand will be unlocked in India?
Thanks for having us, Arjun, over here and giving us an opportunity, to share our views on the subject of such a much relevance in today's scenario. And so, I would also like to add, what Pankaj ji just mentioned that, of course, in India, it's going to be driven by the regulation and, of course, the ESG pressure from the stakeholders. And but globally, and yes, we do have projects coming up where airlines have partnered with us. I won't be naming them, but the names are available in open domain. So this is how it's going to be. And another very valid point which was raised was that often we hear this from domestic airlines ki SAF महंगा hai. But again, if you look at even 1 to 5% blending, I mean, the cost is just minuscule. And studies have been done in last year, there were studies done in Singapore which actually calculated until even 5% of blend, they ran models for 3 flights. One was a long one, which was from Tokyo to London, and even there, the impact was hardly $35 per flight on a 5% basis. So yes, it's expensive, but that's a price you are paying for sustainability. And hopefully, with the volumes to come in, the number, it's the numbers the cost of production gonna come down. Yeah. And now coming to your question, like about us, we are we have 14 years of unmatched journey dedicated to SAF, which positions us very uniquely. A lot of companies which later develop technologies, but initially, like even when you talk about HEFA technology or some other technologies, the genesis of those technology were to make renewable diesel always, it was never SAF. But we are a company which started its journey with the sole intention of making SAF. And as early as 2014, we had a demo plants, our pilot plants, and then 2016 to 20 was the time wherein our alcohol to jet technology based on ethanol from a non-food source, we undertook a lot of ASTM approvals and certification and commercial flights were taken. And thanks to Lanza Tech at that time and now LanzaJet, that 50% blending is now permitted, for A to J SAF. And when I tell you 50%, it's a very important point. It means you need to run your pilot plant for a very long time. A lot of amount of the SAF needs to be made. It needs to be given, to the certification and the testing agency. The test flights needs to be run, with the OEMs, and then you actually achieve a 50% certification. And a time frame of easily more than 23 months is required to do so. The point I'm trying to make is a lot of efforts have gone in, to mature this industry, especially and today, once we have a 50% blending mandate away, and then 2018, interestingly, we also undertook our first commercial flight, which was actually emissions happening somewhere in China in a steel mill. Through LanzaTech technology, we converted those emissions into ethanol, and then that ethanol was ethanol again, ISCC plus certified, RSB certified, which is the gold standards in terms of sustainable products. And those were then converted at the facility Freedom Pines into SAF, and there were two transatlantic flights which happened between Orlando to London, and another one from Seattle to Tokyo. So as early as 6 or 7 years back, we demonstrated yes, this can happen, and then subsequently we spun off the this part of ATJ technology into LanzaJet to wholly and solely focus on development of SAF projects. And there was a reason why we did so. We didn't want anyone to consider that we only take ethanol which comes from LanzaTech process. So we are agnostic to all the ethanols, because at the end of the day, any on-spec ethanol is ethanol, right? There might be different regulations, like Europe doesn't accept like 1G ethanol, but as Sarah rightly showed, like US ethanol is based on the carbon intensity number. Like India is still planning to come up with its own policy. It depends, in UK, like you don't accept like food competing feedstock, but then anything more than like 40% of greenhouse reduction is considered SAF, right? So the reason why the company was spun off, uh, so that LanzaJet can wholly and solely focus on developing like SAF projects. And while predominantly we continue to be a licensing company, but if you look at the projects, which have been which are in advanced stage and pre-FID forms, so we have chosen to take projects on BOO model, on even on the JV modality, and of course conventional licensing one. Yeah.
No, thanks, Vineet. Thanks. A commendable journey, to be honest, for both LanzaTech and LanzaJet. I'll pick one statement from what you said and perhaps ask Pankaj for his views or a validation, let's say, of this. My next question, anyway, to the either of you would have been, where do you see international flights versus domestic flights arising in India, taking, let's say, SAF up, to a small blend? And Pankaj, Vineet mentioned that the cost impact. I won't give the numbers out again, but the cost impact, for example, with a 5% blend is still very manageable when it comes to a price of a ticket to the end customer. Or do you resonate with that statement, or do you have different views?
No, I
Pankaj?
fully agree with Vineet. I fully agree with Vineet. And I also said that even if we assume that synthetic kerosene is 3 times costlier than the conventional fuel, even in a 5% blend means 15% hike in the SAF. And if you look at the conventional fuel price over a 1 year, they goes up and down by 10 and 12%, right? So I agree with Vineet. Up to 1% and 2%, I don't see a challenge. Even domestic area will go for it if government mandates that. And up to 5%, also I don't see a challenge. And I also hope, if I have an optimistic view, then for over the next 2-3 years, at least there would be technology available to make synthetic kerosene cheaper. So even if in current context, I don't think that 5%, up to 5% should be a challenge if there is a mandate from the government that no, you have to do it. Even even in the domestic area, because the very fact is, even the conventional, as I said, even the prices of conventional fuels are going down by 10 to 12% in a year. So plus minus 5-6% cost should be bearable on account of for carbon emission, I think.
No, absolutely, Pankaj. I think very, very good points, Vineet and Pankaj, on the cost impact. But we've talked about synthetic kerosene. We've talked a little about the feedstocks. Let's talk about how to bring all of these from a supply angle. Let me bring Sanghamitra and Sanjeev into this particular segment here. From a supply space, Sanghamitra, we both Pankaj and Vineet have mentioned, there's a cost delta 1.53x, when it comes to sustainable, when it comes to SAF or synthetic kerosene versus conventional aviation fuel itself. We've seen ETJ, pathways being more expensive than bioHEFA. But where do you see the cost levers in terms of where these costs would go down from 1.5 to 3x delta? So Sanghamitra, and the same question for Sanjeev in terms of how do we bring the cost down? Mitra?
Yeah. Hi. Good evening, good afternoon, everybody, and thank you for having me here. So, essentially SAF, when you it's by ATJ route, obviously has a high capex cost. So it's higher than the HEFA route. So if you want to reduce that, then you have to work on the process optimization. That's one major thing which we can work on, how to optimize the process. If you have factors like if you co-locate the plant to an existing ethanol distillery or to a sugar mill, then you reuse those utilities and ensure that the process again is optimized. Those costs are reduced in general. And there is also something, a major fact is the feedstock cost in the entire thing. So that feedstock cost right now also is a major driver for our ethanol costs. But again, coming back to it, ultimately we all know that there are going to be blending mandates and targets and everything coming up. And based on that, the SAF price premium again can be optimized. So if you see 1G, 2G ethanol, so the 2G ethanol actually has a lower feedstock cost, but again, the process becomes slightly more expensive. But then you get high CI carbon intensity scores if you use 2G ethanol. So that again is a good factor that we can work on. And overall, I guess if we optimize the process, we ensure that the location of the plant is co-located. If we ensure that there are financial, in things in place, like you've got uh, incentives from the government, you've got proper funding in place. I think all of that will have a huge hand in ensuring that it's an overall much more financially feasible offering to our, customers and later on to the people who are flying on those planes. Sanjeev sir might add on to it.
Yes, Sanghamitra. Thanks for that. Sanjeevji, what are your views on these levers?
So, thank you, Arjun and Green Hydrogen team to having me here with the eminent panel. See, I would like to say first that is still in India, it is an indicative target of 1%, 2%, and 5%. Although the CORSIA mandate is there, but officially it is an indicative target. And when we talk for the indicative target, and you very rightly said that today's demand is 9 million metric ton. In 9 million metric ton, if you further divide, almost 55% is a international movement, both put together as international airlines as well as domestic carrier moving on the international routes. So both put together, if you go with that, so our demands by 2030 will be around 50 crore liters of SAF. This is our, aim which we are looking for. Now, when you ask before going to the pricing, how can we reduce that? Let us also understand what is the current thought process of the airlines. See, we had, since we are the supplier of the airlines to jet fuel to all of them, so we are very much in touch with them. And we had spoken to almost all international carrier which operates in India, as well as domestic carriers, since domestic is very limited, only 4-5. So we spoke to them also. And what is their feeling as on today when there is an indicative no mandate? Mandate is there, definitely there is no challenge. Indicative means again it's a voluntary. So what I have observed in this total projections, 30% of the airlines says, even the international airlines, that they are ready to go for purchasing of the SAF because it meets their own sustainability policies, because every airline is also having a similar kind of requirement. Whereas 40% says, if there is a mandate, I will change. I will definitely come to that. Otherwise, what is the commercials? Because it should not happen that it is a voluntary. If my price is going up as a voluntary and somebody is not using SAF, his price will be less to the customer. So ultimately, when there is no level playing field, then definitely I have to choose what is right that time. But when there is a mandate, definitely they will go. Now the balance 30%, if you see, they are practically looking that government should give some subsidy, tax credit, the way the US gave the tax credit of 1.25 USD per USG. So can we have a similar kind of tax credit or some benefit or something extra so that my extra cost, which is going to come or maybe levied to the customer subsequently, has to be within that bracket. So these are the basically from the airline side what they are feeling today. And if there is a mandate, the way it is there in Europe, 2025 onwards, now 2% mandate is there for airlines as well as for suppliers, and also they had put some penalties and all those things. So their mandate is fully working. But where in India is still we are, discussing many things, how to move forward. Certain thing we must also understand what is happening today. One is, like Sanghamitra has said, that we have supposed to have a SAF plant where the feedstock is available. Okay, there is a two category of feedstock, HEFA, or another is alcohol to jet. HEFA, we have all, everybody knows that it is better, it is a less, we can say, hydrogen use and all those things, and cost of production will also be lesser rather than alcohol to jet. But the interesting part is that whether the HEFA is available. Interestingly, when we see that all study what we have done, especially for HEPA base, we understand that almost 3 million metric ton UCO is being produced in the country, but only 10% is being really purchased back by for the biofuels or some export. So we are taking with the government also, please stop. If we want to have a sustainable movement further, we have to stop export of UCO, because if the way the China is shown by the presenter is, price is going up, moment UCO will be going out of the country and within the country, definitely today UCO is almost 125 rupees a liter. It will go further up. So my cost today of SAF, which is, let us say, index pricing is 2.5 to 4 or 4 or 4.5. It will be this much cost is automatically coming. So first is a UCO, and UCO also another challenge is that availability, feedstock availability. So definitely long term, which we are looking 5% and above, like Vineet has told that we will be going even more than 5% also. Target is like that. Once the alcohol to jet will come, so we will be going more, much more beyond that. So if in going for the 5%, I have to immediately go for alcohol to jet. No doubt, initial cost of alcohol to jet, because as of today, it is a cost plus pricing in the market. Entire plat plus premium is index pricing, cost plus, so that based on that, this pricing is high. But moment we assume that quite a good number of players will come, because everybody is now looking to come into this picture, and that too especially alcohol to jet in India, because we have a sufficient alcohol available. I mean, ethanol is available. We say today almost by 26, 1500 crores liters will be available as a feedstock. Sorry, is out of 1500, 1050 maybe with the MS blending, balance is available for SAF. And it is quite good feedstock available to make 50 crore liter of SAF. But the thing is that the cost of installation or capex is high. When we say the capex is high, so definitely, ultimately, somebody has to think either revenue has to come from the supply of SAF. So there should be either mandate or there should be a long-term agreement, and there should be a regular revenue, because it has to sustain whatever investment I am going to do. It has to come back, maybe a certain period of time, whatever has been assumed. Another thing, interesting thing which is happening today, like even also Corsia, you see that very important factor. See, we have multiple airports in India, okay, which is operating international airlines. But every airport may not be having a SAF or SAF facility nearby. And if I move SAF from one place to the another place, I will be doing more carbon emissions. And so rather than reducing the carbons, which I'm looking, I'll be increasing the carbon emissions. So what we were pushing to the, to the policy development, especially for book and claim. It is well defined in CORSIA. Like I can give a airport, let us say, for example, in Mumbai airport, if I give, or maybe a Kochi airport, if I give a SAF with certain regulation and registry to the airlines, I can say other place you may not require, you will be able to get 1% or 2% and balance will be adjusted there. Because book and claim method is required. All airports cannot have SAF. If we think that so many airports, everything has to have a SAF, then there will be a more emission will happen. So this book and claim policy, we are in touch with the government. We are looking that DGCA and all they will be looking to come out with clear cut policies on that, so that everybody who is going to take tomorrow, it is clear what credit is going to be there, how I will be adjusting. So going forward, when all these will be settling, because it is a initial phase, all this turbulence and disturbance are there, or I can say that things are moving in a liquid phase, and over a time it is going to be a final stage. Uh, it
Yeah.
is going to be a dynamic pricing based on the market conditions. Today it may be a cost plus, but tomorrow it cannot sustain on the cost plus. It has to be dynamic pricing the way it has to happen all across all the other fuels. So that is my submission on that.
No, very, very
Thank you.
good point, Sanjeev. Let me bring Alvin into this, and then perhaps I can ask follow-ups. Alvin?
So I just want to add on to the point that I think it's very well elaborated as well, that when I'm looking at new plants or companies looking at new SAF production technologies now, a HEFA feedstock crunch involving UCO, POMI, and tallow is indeed being discussed, right? And there are instances where investors and financiers require the company to show some form of certainty that they can secure that feedstock. So most of the new plants coming online, or at least based on what we know, the discussion has always revolved around alternative technology than HEFA. We're talking about ATJ, Fischer-Tropsch. Because according to our numbers, if we combine HVO, which demand from Europe will increase significantly over the next few years, if we combine HVO and SAF, based on current capacity, nameplate capacity data, and demand forecast, by the nearer to the end of the decade, we could potentially see a flip where the whole market is undersupplied. So I just want to add on this point to the discussion. Yeah, thank you.
Important points, Alvin, in terms of the critical balance between demand and supply. Given, of course, availability of feedstock, which sounds to be a unanimous opinion from all of the panelists, where where the feedstock availability is indeed the biggest bottleneck. Vineet, do you want to come in with your views?
Yes, just wanted to add the cost plus pricing, which Sanjeev ji mentioned is a very valid point. And also, Sanghamitra made a point that if you look at the cost of ethanol, 70-75% of the cost of SAF is actually the cost of the feedstock, right? So it depends which ethanol you're using, and the price can often be there. And I often hear this, that the price of A2J SAF is 3 to 5%, like 3 to 5 times of conventional fossil. So that again depends on which technology and which ethanol source is being used. But to circumvent this challenge only, when we saw that this is a notion which is there in market. Last year, LanzaTech and LanzaJet, we came out with a joint offering by the name of Circular, which you read behind me. And that is actually, we use other waste feedstocks, which are the industrial gases, the steel mill emission gases, which actually can make ethanol at a very competitive price, a price close to 35, right? 35 rupees. And then when an ethanol at this price is used to make SAF, the competitiveness actually, it goes into the SAF cost of production, right? And you can have SAF at a price of 2x of the fossil SAF, right? So industrial waste gases, refinery fuel gas, ferroalloy gases, and this is all, I'm not saying can be done. We have actually demonstrated this, there are plants up and running which are doing this. And also then another feedstock which can actually be used to make ethanol are biomass and MSW, so which are again very high on carbon intensity. And last one, which I think was which Alvin was touching upon, Fisher drop, you say, right? Fisher drop is something in which works on syngas. Now, going forward, if you look at what ITA is saying, that post immediately, until now, whatever like SAF was, that it was obviously because of the HEFA. That was the only proven technology. And again, what Sanjeev ji mentioned was there's a challenge with respect to feedstock and Yoko aggregation. How do you get that feedstock, right? So, which will actually always limit the size of a plant, apart from someone who can actually import the feedstock, but then again, the price of Yuko will go high, right? So, what ITA is saying that going forward, it will be from ATJ and then subsequently gasification of this biomass, agri-waste feedstock, and MSW, and eventually after 2035, it will be from the PTL projects, right? Which you call the RFNBOs, because the cost of green hydrogen
Yes.
would come down and you can make SAF. So enough of supply would be there. So the technology which we have through circular, at the front end, we can use any of these feedstock to make ethanol. And then eventually, in the coming years, you see that ethanol can be converted to SAF. So no shortage of feedstock, enough of industrial gases you have. It's only deploying the technology and making it happen.
I think Vineet, Vineet, Alvin, Sanjeev ji, you have laid out a very good pathway as well in terms of where we move today based on availability of feedstock, the cost sensitivity for several of the, feedstocks themselves, ethanol, the highest one. And then in terms of being regulatory compliant as well, going towards RFNBO that the Europeans are pushing for. So when it comes to regulations, let me jump to that because I'm very mindful of an exciting discussion, but mindful of time. I want to touch upon regulations, which at least in my my personal opinion, it's a large lever, to all of this, right? It's a big sibling that's overlooking, market opening up. Now, when it comes, I think all the speakers have spoken about Corsia. We've spoken about RFNBO very briefly. We've touched upon the voluntary nature or indicative nature, let's say, of the 1-5% blends in India. Given the current situation of Corsia, of the European rules and on the Indian rules, what would your one very, very burning suggestion be? Burning, not literally for fuel, but a suggestion be to the Indian regulators specifically, in terms of improving the current regulatory environment to promote SAF in India. One specific, let me do a round robin. Starting, let's say with Sanghamitra, what would your one regulatory intervention be that you think India should do differently?
All right. So we at Praj, we have slightly experienced in this, like Vineet said. So we had one demo flight which took off a couple of years ago. So we do understand the kind of regulations and the time and the kind of work we had to do to get that ASTM certification done. So I guess for me, one thing would be to have a better coordination amongst DGCA, MOCA, NABCB right now, because they are also, so we do have that in India right now. We have our own NABCB in place at the moment. So we do not have to go outside and get RSB or ICC to come in and certify anything, right? So we need that coordination amongst these parties for streamlined certification. And I want to add one more. I know you did say one, but the thing is, we have, if you remember, if you know this, we have a batch-wise certification at the moment. It's still required. But what we do need is we need a facility level approval. That is pending, right? So this is something which are two of my points which I would like to add on regarding the certifications.
Thanks, Sanghamitra. Two are allowed because both of those were good suggestions as well. Pankaj,
Thank
what
you.
would your one or two suggestions be when it comes to regulatory interventions in India?
Yeah, actually, I may not talk about from the production point of view, but one thing I would like to say very emphatically, and as an airport operator, we do a lot of advocacy in this field. One thing which Government of India should immediately do is to bring jet fuel under GST, right? Because what is happening, I'm not saying that this is directly related to SAF, but this would be kind of a precursor. right? It will boost the ecosystem. And if tomorrow, if GST if jet fuel is under GST, what is happening currently that airlines are not able to take the input credit, and there is a lot of double taxation, right? Because it is under still VAT regime. And if it is under GST tomorrow, if SAF is being produced, then airline may at least claim, input credit on GST with their payment, SAF. Second, I would say that taking cue from this, SAF promotion scheme, which UP government has suggested, I happen to go through that. I mean, there is a pressing need for government of India to promote the ecosystem for SAF production, right? I don't know, I may not elaborate on that, but by ease of doing business. So like in UP, what they're doing is that if you're putting up a SAF plant, they are waiving off the land uses charges, right? Right? Or they are giving the tax off for the next 2 years or 3 years. So actually, the whole synthetic kerosene producing ecosystem needs a good push from the government of India. That I would say to start the ball rolling. Once things are set, maybe 2 3 years down the line, once we feel that things are settling down, there's a equilibrium in the ecosystem, then of course things can be withdrawn slowly and steadily. But immediately it needs a push.
No, good points, Pankaj. The UP policy, I believe, also has some interventions or some support for feedstock aggregation
Yeah,
platforms
absolutely,
as well.
absolutely.
Someone did mention that could be a commercial opportunity where you're aggregating feedstock from farms and ethanol production sites as well. That could be a good model for sure. Great. Vineet, what about you? What would you say as your burning suggestion for regulatory changes?
First and foremost, which was earlier touched upon by Sanjeev and Pankaj, would actually be converting the indicative blending target into the mandates. Until we have that, ये कुछ नहीं आएगा. मतलब बातें होंगी, कुछ नहीं आएगा. Once the mandate is there, if you look how ethanol story happened, how our solar, both are actually proves, if there's a will, this can happen, right? So once the mandate is definitely there. Second is again, there's a bit of hand holding required to initially, ensure that this industry can compete with the fossil. And in terms of financial incentives, how US is doing it, they have giving incentive of say 1.25 per gallon to 1.75 depending on the carbon reduction. UK has come out with premium pricing, right? So something of that sort needs to be given to ensure those who are making SAF project developers go, I think they're able to recover the money, right? Otherwise, वो फिर हो नहीं पाएगा, and just one last thing, which is actually very important, and what we have seen in last 1.5 years, there's a lot of traction among all the players. They want to talk about SAF, but once you talk about taking it to next level, there's a kind of pre-FID work which needs to be done. वहाँ पे there's a lot of reluctance in investing, because the technology player, he needs to generate a basic engineering design package. There's a consultant, which an owner will hire to carry out and arrive at a number of plus minus 10 to 15%, to take a go or no go discussion as a projects. Now, what is happening abroad is governments are, coming out with grants for this. Like you might have read just last week, UK government, right? They came out with 63 million grant was given to various companies. They run a competition. Department of Transport over there under the Advanced Fuel Funds, wherein they invited entries. There was a process. They screened the projects. They saw what's the proposal are there, and then the grants were given to take a project, to next level. And luckily, like LanzaJet and LanzaTech, there are two projects of R, which we are developing and taking it to FID level. So such support is required in India also, if that can be taken care. Otherwise, talks won't actually materialize. Thank you.
Good suggestions as well, Vineet. Sanjeev, what about you? One, if I can request you to be, give a very brief suggestion.
See, I would like to recommend already Sanghamitra and Vineet ji has recommended, but in addition to that, I would like to recommend book and claim method because one airline or we may be an international carrier or domestic carrier is operating for different airports. So making the mandate of let
Hello.
us say 1%, 2% or 5%
Hello.
is not possible the SAF availability at all the
Yes, sir.
airports immediately till the entire supply chain is available. So book and claim method is one of the well established in Corsia, which they have mentioned it. Our government is working no doubt on that. The way they have come out with the NABCB accreditation, because earlier only ISCC and RSB were there. So two international body, then we have raised this concern, at least in India also, we should have some our own. So NABCB is now having a MOU with ISCC. So definitely now accreditation body like NABCB is having a further certifying bodies. So I'm sure this will take care of certification process is very, very fast. But going forward, I will recommend that book and claim and tax credit, if definitely will be there, it will be helpful to the people, the way Viriji has said. And this will be my request for them.
Very, very potent suggestions by everyone. Alvin, if I can, ask you for your closing comments before we go to Q&A, in terms of what you think are good best case practices when it comes to regulatory interventions that you might have seen in the region or in Europe, for example. What are your thoughts of 2 or 3 suggestions that the Indian regulator might be able to take up?
I'll keep it quick. I think for Europe, there's very clear mandatory usage of SAF, very clear penalties as well. If you fail to hit the target, the penalty fine is 2 times the spread between SAF and JET. So you have to do it. That's one. Second, the Singapore model could be one for reference as well. So the Singapore model, to keep it short, they charge a levy on all departing passengers. They pool the money. The government set up a private company to purchase as much SAF as they could with the money pool, and then they will just blend and pass it over to the airline. So the airlines keep it relatively simple. The third is the Japanese government also provides some sort of subsidy as well. They subsidize 50% of capex costs for ATJ technology and a slightly lesser percentage for HEFA as well. I think with these three, there will be very clear and very certain demand for SAF usage in India. Thank you.
No, very, very succinct but powerful messages, Alvin. So I've taken the book and claim that I think the unanimous suggestion has been, penalties as seen in the UK. So that's a stick approach, but balanced with a carrot in terms of the capex subsidies as well. But I think the most important that you all indicated was that the indicative targets for blend, for instance, in a country like India, should certainly become mandatory. So those are very good suggestions here. Let me see. We have 5 minutes, but it's been a brilliant, intense discussion. We have 5 minutes for perhaps 2 or 3 questions from the chat box. So let me go through the chat box and suggest some for the panel. Once for Sarah. Sarah, if you want to bring yourself back in as a speaker, that would be very useful. I'm sure there'll be some questions directed to you and Alvin from Arcus's perspective as well. So the first question, Manesh asks, how do you see the use of other SAF pathways other than HEFA and UCO? We've talked about ATJ, ETJ, etc. But is there a comparison? And I will add to his question, is there a comparison on costs today? And in terms of market readiness from a TRL level perspective? If you can give a 30-second answer to that, Sarah or Alvin.
Sarah, want to take that?
Yeah. Okay, sure. Yeah. So that was Manesh's question, right, on alternative pathways. Yeah,
Yes,
I
sir.
mean,
Alternate pathways, and
yeah.
where do you rank them? Let's say, versus HEFA. I'll give you 2 parameters on cost and on technology readiness.
Okay. Yeah, I think especially in the context of India, like which you guys definitely have a lot of ethanol supplies, in addition to the 3 million tons of UCO that Kumar mentioned that hasn't been tapped yet. So I think ATJ would likely be the next main pathway to look at. Yeah, definitely crops like corn, sugarcane, etc. It's more abundant, but we also have to consider that say like the CI of corn-based ethanol might not be as favorable. Yeah, in terms of gasification and FT and power to liquids, I would say those are further down the line because some of them might not be commercially viable as well, and production costs are still high.
Sanghamitra, perhaps a question from Sarfaraz Hussain to you. The same question that I've asked Sarah in terms of the market readiness for these production pathways. He asks, where do you think India is going to see SAF production through? Is it ATG or HEFA? And perhaps in the medium term, if you have to agree with the pathway that was mentioned earlier, do you agree or do you have a different pathway of technologies?
Hi. No, so I kind of vouch for ATJ because going in the long term, that is the most feasible pathway for India. Considering the fact that even after our ethanol blending targets are met, we do have an excess ethanol available. And I guess I'll just continue with what Vineet has also said. We need to optimize the process, as I also said before. So just creating SAF is not going to be enough. So what we can do and what we are doing at Praj also, we are trying to build a biorefinery concept. So whatever feedstock you give, be it biomass based 1G, 2G ethanol, and we can create ethanol, and we can also give you these value added products all around SAF. So ultimately, so when somebody is investing on it, when somebody has a plant to put up, you can earn money from all of these small products as well. So it's not just SAF that is going to pay you, it's going to be all the other things, and this is possible only in a pathway like alcohol to jet because of the feedstock that you're going to have. And HEFA right now, yes, it's most valuable, but going forward, it's not going to be enough to meet the targets.
Excellent, Sanghamitra. One very, very quick response sought from Vineet and then Pankaj on the safety aspect. This is a very, very critical one. I will relay this question in a different way from Manish Pardesi, who asks, what's the right percentage, let's say, of SAF blend when it comes to safety? And I would add add to his question, safety of the engines on an aircraft, as well as safety of storing it as well. Is there a percentage target that we need to look at given the current infrastructure? Vineet and then Pankaj, and very quick 30-second response, please.
So far, like I was mentioning earlier, our SAF can be the SAF made through our process. 50% blending is allowed by ASTM. So there is actually no safety concern with respect to that. And why I tell you 50% also, that's also predominantly because as of now, how engines are made, a minimum 8% of aerobatic is required, for sealing of engine. But going forward, we see the OEMs are already working on the next generation, which can actually be able to accept a more blended percentage of SAF. Now, we're talking about 50% SAF. That's still a long way to go, so it's completely safe. Mankaji, you can add.
Sure.
Yeah, I would be very crisp and concise. No such consideration. I think that synthetic kerosene and fossil fuel is absolutely same in terms of flammability. So I don't really see any challenge they are absolutely oblivious to each other. Safety and all this stuff. Absolutely clean. I'm sure about it.
Loud and clear. I think with that very, very positive tone that, from a safety angle, we hope to see no hiccups when it comes to, blending even higher degrees of percentages. Safety, of course, is critical, but we don't see a challenge when it comes to the blends. I think it's been a brilliant discussion, ladies and gentlemen. Sanghamitra, Sarah, Alvin, Vineet, Sanjeev ji, Pankaj ji, it's been a pleasure attempting to moderate your extensive experience in the sector. We at GH2 India are delighted to have you here. So thank you once more. And thank you to all of our 200 participants who took time on a Friday evening to join this critical discussion on SAF. The recording of this will be made available as well on YouTube and our website as well over the next couple of days. And Sarah, I think you've agreed to share the presentation or a version of this with our listeners. So appreciate that too. Do send in your questions if you have any additional ones for the speakers. We're more than happy to relay it to them. But on the behalf of GH2 India, thank you and namaste.
Thank you so much.
Thank you.
Thank you. Thank you, everyone.